entering equity markets is initially scary. Is there some incident in the past that is playing on their mind or has impacted their psychology? So people have to be taught that to not think of money only in absolute terms, but to think of money in an inflation adjusted manner. Investors should avoid leverage. The main impact of volatility is on leveraged positions. The earlier set of investors, the earlier generation of investors saw outsized returns in real estate. There was a reason behind that. We have moved into a phase of jobless growth thanks to the movements of technology, so the vast improvements in technology. Here you can easily buy a house of 1 crore by just paying 20 lakh rupees and leverage yourself. And in many cases, the goal is simply to generate wealth for the next generation. Make all our research and all our processes as process driven as possible. And that is my one learning from Mr. Moradian. So the FIIs today currently have about $68 billion in Indian equities. The fact that they believe that Trump will reduce corporate taxation rate in the US.
So welcome back everyone to this insightful conversation we are having. If you have just joined us, my name is Vishal Singh and we have with us Mr. Amit Sahita, who has been sharing his vast experiences of financial markets and a bit of his personal life. So in this part, we will be covering questions on personal finance and investment strategies. So let's start it. So sir, my first question is, like post-COVID, I have seen many people having this kind of conservative mindset and they kind of put their money either in their bank account or in FDs. So they are a bit hesitant to enter into the market, the stock market. So what can be done to bring those hesitant people back into the market and how it can be done? Yeah.
See, entering equity markets is initially scary for those who have not done that earlier. So the approach cannot be all in. It has to be a slow, incremental, gradual approach. And the approach has to be in a way where also some effort is understood to deal with the objections of the investor. Why are they afraid of the equity markets? Is there some incident in the past that is playing on their mind or has impacted their psychology? In many cases, we come across some instances of the 1990s or 2000s where the parents are consistently been advising people, please don't go to the stock markets, they are casinos. So the Harshad Mehta incident, the Ketan Parekh incident has marred the psychology of investors. So has the 2008 subprime crisis. So these such investors who are very, very scared of the volatility of the equity markets have to first be educated about why equity is necessary part of their portfolio to combat inflation. In the long run, if people only put their monies in fixed deposits, we know for a fact that they cannot realistically beat inflation. Yeah. A fixed deposit today yields around 7%, inflation is around 4.5%, 5%. Post-tax return of a fixed deposit for a high earning individual would be around 5% also. 7% minus whatever taxes they would pay would be very close to 5%. That means that they are not beating inflation. So people have to be taught that to not think of money only in absolute terms, but to think of money in an inflation adjusted manner and to think long term, to think 10 years, 20 years down the line. Will investing in fixed deposits lead them to buying the same goods and services 10, 20 years down the line if they are not beating inflation? No. Yeah. Whereas if you invest in a basket of equities, lower the risk by diversifying, the chances of beating inflation are much, much higher on a tax adjusted manner. See, tax here plays a very crucial role. Yeah. 7% in fixed deposit minus 36% tax that anybody who is earning above 15 lakhs pays is only 5.3%. Yeah. Whereas if you invest in equities in the long run, you can defer that tax until you sell those equities. Yeah. At the end of the day, equity for many years in the market has proven to be the ideal asset to combat inflation.
Sure. So, you think it should be taught from the basic level, like the schooling level thing? Like,
Ideally, yes, but maybe children in the 8th standard or 9th standard can be exposed to economics like this.
okay.
It will take some time for personal finance to start becoming a subject in schools. But I do see that maybe 5 or 10 years down the line it will happen meaningfully.
Sure. And so there has been, multiple market corrections from, let's say, 1992 to 2024. So how should individual should cope up with it? Like, what should be the reaction and how his or her investment should be saved? Like, how can an individual save their investment?
Corrections are going to be a part and parcel of markets.
Yeah.
We have seen multiple corrections, be it the 2000.com bubble burst or the 2008 subprime crisis or 2020 COVID crisis. We will continue to see volatility. It's inevitable. But investors have to be taught to follow the method of asset allocation. What is asset allocation? Asset allocation is determining in a planned manner what exactly are you investing in equities and what exactly are you investing in fixed income products. If a person is systematic and disciplined and follows a planned approach, then they will not be phased or they will not be excessively worried by the corrections which are part and parcel of markets. Also, investment cannot happen in an all-in manner. It has to be a slow, gradual process. And if systematic investing happens, then those corrections will also provide great opportunities for investors to enter equities at a lower price.
Definitely so. But so people do invest in the market after doing some kind of research or fundamental analysis or technical analysis. But what I think is they sometimes forget one important thing, that is the emotions as well. So how should one develop that emotion to cope up with the market, and they should not be afraid of what they are seeing in the market, like the volatile market?
The answer is in awareness and in education. Also, investors should avoid leverage.
Okay.
The main impact of volatility is on leveraged positions. If someone is not leveraged and if there is temporary downside, then the investor will not be as worried as someone who is, let's say, taken huge positions via futures and options or margin trading. So investors have to be educated to avoid leverage and to understand that volatility is part of markets. You will see phases of times when there are excessive euphoria, and you will see times when there are excessive downsides.
Sure. And so from the point of a wealth manager, like what are some of the common mistakes people do with their money, like in their early stages of life?
So emotions play a huge part of mistakes. One common mistake that I see is trend investing.
Okay.
So a few years back, the hot trend was cryptos. So everybody would talk about cryptos, they invested in cryptos, and you would see that on social media, on media, huge amounts of discussion on cryptocurrencies. Another such hot trend was startup investing. So people sort of fell in love with the idea of startup investing, and I saw so many people invest in their friends' startups or their family members' startups with very little thought of what would be the fundamental strengths and weaknesses of the startup. So this is what excitement causes. This is what greed causes, or rather a trend investing causes. On the other side, I see a lot of people who invest out of fear. They want to avoid equities. They have disproportionate investments to real estate. somehow they think that real estate investing is a safer option rather than investing in equities. So I see people investing vast amounts of monies to real estate and gold. A certain amount of allocation to gold is definitely advised in all portfolios. But real estate is, to my mind, is not really an investment asset at all. It is a consumption asset with yields of 2.5% rental yields in housing investment. It makes very little sense to hold more real estate than you actually require. Yet we see many people who will have a second house and in many cases third houses. This is again can only be corrected by education.
Okay.
If a person actually calculates their XIRRs of owning properties and does the math of after what was that they earned after buying and selling of a property where the entry cost includes sometimes GST and in many cases transfer fees and other costs and the cost of maintenance and the cost of repair, they have to ask themselves whether they made any real profits from owning excessive real estate. So the first, we saw that it's more about greed. The second, we saw more about fear. These are the common mistakes that I see. Also some other practical mistakes where they don't have a planned approach, but more of an approach where they end up investing very instinctively or very on a very spontaneous type of level. Somebody pitches them a product like a ULIP or some insurance product they don't fully understand, but yet they go ahead with the investment.
Okay.
So at times like this, they should consult a financial advisor or a wealth manager and understand what they are investing into.
Okay. So sir, according to you, like you just talked about the real estate investment, like, so if there is, like, there should be investment, like there will be some returns, that's why they are, investing in it. But why a lot of investment is happening, particularly in India, in the real estate sector? Like, according to you, what might be the reason?
There are three major reasons. See, one major reason is that the earlier set of investors, the earlier generation of investors saw outsized returns in real estate, and there was a reason behind that. In the 90s and 2000s, real estate prices really went up because a lot of job creation was happening in the economy.
Okay.
So in every economy, be it the US economy, be it the European economies, whenever there is job creation, real estate prices do tend to move.
Okay.
Because new job winners do tend to buy houses. Recently, that phenomenon has not been happening. We have moved into a phase of jobless growth thanks to the movements of technology, so the vast improvements in technology. So the earlier generation keeps goading the new generation, oh, you have some surplus, don't waste it anywhere, put a down payment in a house, start your EMIs.
Yeah.
So you will hear many parents give that kind of advice.
Yeah.
That advice is not relevant today.
Yeah.
In the buy or rent equation, renting is the smart thing to do in most cases. If the yields are 2.5%, absolutely. The second reason why we see disproportionate investments towards real estate is a lot of cash generation in our economy.
Okay.
30%, 35% of our economy is run on cash and completely unaccounted for and does not appear in any of the tax calculations or the GDP calculations. When there is so much excess cash, there is a tendency to try to evade tax and to there are very few avenues of investment left for the evaded black money. Eventually that finds its way into real estate. And the third is the government up till now was incentivizing real estate investments by giving tax breaks.
Okay.
And leverage. Here you can easily buy a house of 1 crore by just paying 20 lakh rupees and leverage yourself.
Yeah.
Of course, you are subjugating yourself to 20 years of EMIs.
Yeah.
But yet you have that opportunity to invest a vast sum at one go at, let's say, in your mid 30s, without realizing, oh, I am now being forced to pay for 20 years the same EMI again and again and again.
Yeah.
So temptation is very high to invest that vast sum with very limited money. And with the tax breaks, these three reasons were causing too much investment in real estate. One is the parental guidance. The second is the black generation. And the third is the incentives from the government and the ability to leverage.
Yeah, sure, sir. And sir, you have been into managing wealth since very long time. So, what is that process of making that customized portfolio for any individual or any HNI individual? So, what is that process?
So at FinCode, the process we follow is we accumulate all the data of the family. The financial data includes their current investments, their current savings, their current portfolio. It includes their monthly incomes, it includes their monthly expenses. We calculate their monthly surpluses. We chalk out their financial goals and their plans in the foreseeable future, going down sometimes 15 years, 20 years in the future. The goals could be something like children's education, children's foreign planning, children's marriages, retirement planning, succession planning. And in many cases, the goal is simply to generate wealth for the next generation. And based on these information criteria, we chalk out a plan that is most suitable and customized in that particular situation. Of course, we also take into account their obligations and their pending loans and EMIs.
Okay. So it does include the risk factor as well, like
absolutely. The risk tolerance and the risk appetite of the individual is very much part of the process. We have a systematic process to figure out whose risk tolerance is at what level before we start the investing process.
Okay. So what is that factor like based on which you guys decide that the risk factor, the risk appetite of that person is more or less or moderate?
We have elaborate conversations.
Okay.
We have an elaborate questionnaire to figure that out.
Okay.
And based on the scoring of this questionnaire, again, like I said, I have tried to make all our research and all our processes as process driven as possible. And that is my one learning from Mr. Moradian, that humans can make mistakes, but processes cannot.
Yeah, definitely.
So in this also we follow a very, very systematic and scientific process.
Yeah. And so according to you, like how much a person should invest and save for his or her future?
An ideal way of figuring out what is the target for retirement is 30 times your annual expenses currently.
Okay.
So let's say a family's expense, I'm just giving you an example, is say 10 lakhs.
Sure.
Then 30 times that, 3 crores is what your target should be to as a retirement target to maintain the same lifestyle with no compromises post-retirement.
Okay.
Assuming you have no other incomes but from the corpus.
Okay. And so how should a person diversify his or her portfolio, and what is the process behind that? Like, is there a process to diversify if he or she is not asking any high-end individual or asking for any help? Like, is there any process to do it?
So if a person is looking to diversify their portfolios, a person should look at a basket of investments in a way where there is less correlation between those particular assets. So let the basket have some mutual funds, some direct equity, some fixed income securities like bonds and RBI bonds and fixed deposits, and some gold. Those would be the components. Depending on the person's risk appetite, different components will have different weightages.
Sure.
So a more risk-taking person will probably go for 80% equity. A less risk-taking person will probably go for 50% equity.
Yeah. So my next question is like, how do you come up with your valuation number? Like, is there any method doing it?
Absolutely, we have a process. We crunch a lot of economic data on a monthly basis. Data such as bank credit growth, IIP figures, PMI figures, electricity consumption, diesel consumption, and so on. in the valuation process, we are constantly, one of the processes that we use is comparative valuation. Is Infosys more richly valued than TCS, more richly valued than Wipro, and why? How does a HDFC Bank's valuation compare to a ICICI Bank's valuation? How does it compare to a Kotak Bank's valuation? The DCF methodology is used at a primary level, but more on a day-to-day basis, a comparative method of valuation is more practical.
So here with that, my next question arises, like, I have seen that the gold market and the Indian equity market are inversely, proportional. So according to you, like, how should an individual should invest? Like, they should be equally towards the gold and the equity, like how it should be?
Depending on a person's risk tolerance, we advise investors to have a between 3 to 5% exposure in their portfolios to gold. Yes, gold and equities are not correlated. If you look at the performance of equities and gold, you may see that okay, they are quite they've performed almost comparably. But in equities, you also have a dividend component that is playing out every year, which gold does not, and the taxation for equities is much lower than gold. Also, gold tends to do much better during times like these when there are wars. But in peace times, usually equities outperforms gold quite easily.
Okay.
So our typical advice to clients is to keep gold at between 3 to 5%, not more in a portfolio.
Okay. And so one more question regarding the stock market, like in 2024, I have seen like the FIIs and the DIIs are putting out their money from the Indian stock market. Like currently also the past 2 days the market has been down. There has been multiple factors, but the trend is that FIIs are reducing their investments in India. Like what should be the reason, like why they are putting out their money?
So the FIIs today currently have about $68 billion in Indian equities. They form around 15% of overall market cap. They are the owners of 15% of Indian equities. They have sold roughly around 8.5 billion recently, which is around 1.5%, which is about, again, 4-5% of their overall holding, 6.5% of their overall holding. A lot of factors play into why FIIs are doing this. One, of course, is China's stimulus.
Okay.
The other is the fact that they believe that Trump will reduce corporate taxation rate in the US and make those equities better prospects than ours. Also, RBI has not reduced rates here because of inflation. So, in this relative time frame, they are seeing more attractive opportunities in China and the US. Another factor is Japan and how the yen in the last month has depreciated from 140 to 154 against the US dollar. So Japan has also relatively become cheaper for a FII, 10% cheaper, and India hasn't become that cheaper.
Yeah.
So until that they find the valuation level that they are comfortable with on a relative basis between US, China, Japan and India, they will continue to have a bearish point of view.
Okay, so till what time do you expect that this will go on?
Our sense is that we could see another 4 or 5% of downside in the short run, because again, how we are placed relatively against China and Japan and US. So please appreciate that India now is the 5th largest economy and soon may become the 3rd largest economy going forward. So we are now a significant player.
Yeah.
And with the size also comes the responsibility of maintaining great economic numbers.
Yeah.
Our latest economic numbers on the IIP side, on the PMI side, have been a little little lower than expected, and that is also why the FIs are selling.
So probably my last question, like now Swiggy IPO is coming. So what's your take? Like how will it perform?
The Swiggy IPO just closed
Yeah.
during market today, and we in particular are bearish on the IPO
Okay.
because of three reasons. Swiggy, after 10 years, has not been able to operationally break even. It is still making losses on the operational level. So its unit economics is not in place. Secondly, the founder team issued ESOPs to themselves in April this year at a lower valuation.
Okay.
Obviously, if the founder team does that, it's at the cost of other shareholders. And the third thing is that it's coming out at valuations which we are not comfortable with.
Okay.
So we believe it's too pricey,
Mm-hmm.
and we don't think it will go the Zomato way.
Okay. But eventually you are bearish on it.
I am bearish on it. I would advise my investors to avoid it.
Okay, sure. So it was great talking to you, and we have our privilege, and we would like to host you again. If you are free, we will definitely connect with you. And it was great talking to you, sir. And again, thanks a lot, sir.